Assalamualaikum and very good day to everyone, especially to Sir Muhammad Izzuddin. My name is Nur Isati Beti Endop. In this video, I will be presenting a topic which focus on capital structure. In this presentation, I will cover 8 main points. The first one, we will understand what capital structure is. Then we will look into how to determine the optimal capital structure for a company. Next, I will explain the factors that influence capital structure decision and also touch on financial distress. After that, we will see how that effect and financial distress costs are integrated in decision making. We will continue with the concept of agency cost of equity. Then I will discuss the pecking order theory, and lastly we will look into signaling hypothesis. I hope this presentation will help everyone gain a clear understanding of how capital structure decision affects a company performance and value. What is capital structure? Capital structure is how company gets the money it needs to run and grow. This money comes from two main sources, equity and debt. Equity is money from the owners or shareholder. It also includes profit the company keep instead of spending, called return earnings. The company doesn't need to pay equity back or pay interest, but it has to share control and profit with shareholder. Debt is borrowed money, like loans or bonds. The company must pay it back with interest. Debt is usually cheaper than equity, and the company keeps full control. But if the company borrows too much, it can be risky. A company needs to balance both and equity. Too much debt is dangerous, and too much equity means giving away too much profit and control. The best capital structure depends on the company's size, goals, and how much risk it can handle. In short, a good capital structure helps the company grow safely, makes better profits, and build trust with investors and banks. In this part, I will explain the optimal capital structure. The optimal capital structure means finding the best balance between debt and equity. This balance helps a company grow while keeping costs and risk low. It's not the same for every company because it depends on different things. There are 4 important factors that determine what the optimal capital structure should be. The first one is the corporate life cycle stage. New company usually don't have steady income yet, so they rely more on equity from their founders or investors. But once the company grows and start making regular money, it can use debt to grow faster and save money on costs. Second, tax benefit of debt are a big reason for companies like to borrow money. When a company pay interest on its debt, it can reduce its tax, which is a good thing. However, if a company borrows too much, it becomes risky because it might have trouble paying back the debt when income drops. The third factor is the risk of bankruptcy. Companies that have steady profit and good credit can safely use debt, but newer or riskier companies should avoid too much borrowing and instead use more equity to protect themselves. Last but not least, business risk is important. If a company income is very uncertain, like in fast-changing industries such as fashion or technology, it's safer to avoid heavy debts. This company need to stay flexible without big loan payments weighing them down. Now let's talk about how we determine a company optimal capital structure. At the top, we have the formula for WACC, or the weighted average cost of capital. This formula basically calculates the average cost a company pays to finance its operation using both equity and debt. So WACC tells us how much it really costs the company to raise money, considering both debt and equity. Now if you look at the graph, the blue line going up is the cost of equity. As debt increases, equity becomes riskier. So equity holders demand a higher return. The flat blue line near the bottom is the after-tax cost of debts, which stay relatively low at first because of the tax benefit of interest payment. The right U-shaped curve in the middle is the WACC. At first, as the firms add debts, the overall WACC goes down. That because debt is cheaper than equity, especially after the tax shield. But if the company keeps taking on more debt, eventually the cost of borrowing rises. Equity becomes more even riskier, and the WACC starts to increase. The lowest point of that red curve, labeled T/E, shows the optimal capital structure. That is the mix of debt and equity that give the company the lowest possible cost of capital and maximize its value. The goal is to find that balance, not too much debt, not too little, where the company is financing itself eventually without taking on too much risk. What are factors that affect a capital structure decision? There are 4 factors that affect a company capital structure decision, and there are profitability, fund size, nature of asset, and taxation. First, profitability. When a company is making good profit, it doesn't need to borrow much. It can use its own money to grow the business, which is safer and cheaper. But sometimes, even profitable companies use some debt to enjoy tax benefits. Okay, the next one is fund size. Bigger companies usually have better access to loan and lower interest rate because they are seen as more stable. Smaller companies might struggle with borrowing, so they tend to rely more on equity. Then we have a nature of asset. Companies with physical assets like buildings or machines can use those as collateral to get loans. But if a company mostly have intangible assets like software or brand value, it's harder to get that. So they use more equity instead. Last but not least, taxation plays a big role. Interest on debt is tax deductible, which help reduce the company tax. That makes debt more attractive. Still, too much debt can be risky, so companies need to find the right balance. What is financial distress? Financial distress is when a company is having trouble paying its debt on time but is still running. So that means that company is still running. Think of it as a warning sign before things get really bad, like going bankrupt. Okay, it's not just a problem for the company. It also affects employee, customer, supplier, banks, and even the company around it. There are 2 types of costs involved: direct costs and indirect costs. The first one, the obvious one, like lawyer fee and court costs. But there are also hidden costs that can hurt even more, such as losing customer, damaging the company reputation, missing out new opportunity, and paying higher interest rate because lenders see the company as risky. To turn things around, companies need to act fast. They might cut unnecessary costs, renegotiate debt terms, sell off things they don't really need, or bring in new investor for some cash. Beyond money, improving how the company runs by being more efficient, such as using new technology, changing up their strategy, and having good leadership and communication is just as important. Catching financial trouble early is key, so companies should keep a close eye on their finance and get advice when needed. Taking this step can really help reduce risk and give the company a better shot at bouncing back and growing strong again. The idea of integrating tax effects with financial distress means understanding how money problems and tax affect each other, and using that knowledge to make better decisions. During hard times, planning tax well can help the company save money. For example, the company can use tax rules to pay less tax. This saved money can be used to pay workers, buy things needed for the business, or pay important bills. This helps the company have more money to use every day. Debt is also important. When the company borrows money, it must pay interest. The good news is that the company can lower its debts by using this interest as a deduction. This is called a debt shield. But if the company borrows too much, it can cause bigger money problems. So the company needs to be careful with that. If the company goes bankrupt, some debt might be forgiven, but that forgiven debt can count as income, and then company may have to pay tax on it. This can surprise the company when it is already having trouble, so it is important to notice that rules. Sometimes, companies with money problems try to pay less tax. This might help a little at first, but it is risky. It can cause problems with the government or make investors lose trust. To do better, companies should talk openly with tax officers, pay the most important tax first, and sell things they do not to get money. Using smart tax plans and managing money well can help the company survive hard times. In the end, tax are not only a problem. If a company understands how tax and money problems are connected, it can use that as a tool to save money and get better. This helps the company make good choices and have a better future. This slide is a great visual of what we mean by the integration of debt effects and financial cost distress. It's all about finding the right balance when a company decides how much debt to use in its capital structure. On one hand, there are tax benefits to borrowing. Interest payments on debt are tax deductible, which effectively save the company money. That's the tax effect we are talking about, and it adds value to the firm. That's why we see the curve rising early on in the graph. But on the other hand, more debt also means more financial risk. If a company borrows too much, it starts to face financial distress costs. Things like bankruptcy risk, reduced flexibility, or higher interest rates. These risks start to eat away at the firm value, which is shown by the downward curve on the right line. So the integration part in the title refers to how these two forces, debt saving from debt and financial distress from too much debt, are both factor into the company overall value. The sweet spot is where the balance out just right, which is marked as D, the optimal debt level. In short, this graph shows us how companies try to make the most of their advantages without tipping into dangerous territory with that. However, this gap also relatable in the part of the optimal capital structure. Agency cost of equity happens because there is sometimes a clash between what the shareholder of the company want and what the manager who runs the company wants. For example, shareholders want the company to grow and make money, so the investment become more valuable. But manager might have different goals, like getting bigger office, fancy perks, or just trying to grow the company to look important, even if it doesn't actually make more money. Because of this, shareholders have to keep an eye on manager to make sure they are not wasting money or making bad decisions. This means spending on things like audits, hiring independent board members, or giving manager bonus only if the company does well. All this effort costs money, and that's what we call agency costs. Even with all this watching, sometimes managers still avoid taking smart risks or making choices that don't really benefit the shareholders. These problems are worse in big companies where shareholders don't have much direct control over management. So basically, agency cost of equity is the price shareholders pay to keep manager in check and make sure their goals line up. In this part, I'm going to explain the pecking order theory, which is about how companies choose their sources of funding. The idea is pretty straightforward. Business prefer to use money that easiest and cheapest to access, and least likely to raise red flag with investors. First, companies use their internal funds like profit. They are safe up. This is their top choice. Why? Because it's simple. Doesn't require explaining their plans to outsiders and avoid extra costs or market suspicion. If that's not enough, the next option is debt, like loans or issuing bonds. Debt is usually cheaper than equity, and it doesn't take ownership away from existing shareholder. Plus, it can actually send a positive signal like, we are confident we can pay this back. Equity or issuing new share is the last resort. It can make people think the company's stock is overvalued or that it is in trouble. And it also delays ownership, which most shareholders don't like. So in short, companies follow a pecking order. They use internal funds first, debt second, and equity only if they really have to. This is the last part for the presentation, which is the signaling hypothesis. The signaling hypothesis is basically the idea that companies send message to investors through their financial move. Since the people running the company usually know more about how things are really going than outside investors, their choices like selling new shares, paying dividends, or buying back stock act like signals about the company health and future prospects. For instance, if a company issues new share, it might mean they think their stock is priced high right now, which can sometimes worry investors. On the other hand, if they are paying steady dividends or buying back shares, it usually shows they are confident the company is doing well and expect good earnings ahead. This signal helps investors get a clear picture, but it is not always perfect. Sometimes the market can read the signal wrong, or the company might be sending mixed message.